Good morning, everybody. Okay, so we're talking to our interim results for 30th September 2022. There's three items on the agenda. I'm going to do a quick highlights slide. I will then hand over to Alison, who will talk you through the financial review, and then I will come back in to put some colour on terms of the market and trading position. So moving on to highlights. The highlights for us are, in terms of earnings, the quality of earnings has been maintained in these half-year results, despite the headwinds of inflation and interest. And we measure that particularly in terms of return on capital employed, which at 14.4% is still a very good number, and our margins were maintained throughout the period. We've also seen further modest recovery in terms of revenue. This is partially due to agreed higher rate increases with our customers, and also just an increase in activity in certain of our businesses. We've had some supportive markets through the last 6 months, in particular infrastructure and the house build sectors, and that has also helped us trade well against an inflationary bound backdrop. In geographical terms, particularly highlight international, which is a much smaller part of our group, but nevertheless made very good progress, and mainland Europe, where we have two of our divisions operating, also had a positive 6 months. In terms of capacity, the rental fleet is still in very good shape. We've maintained our fleet investment levels, and allied to the next point on ESG, our focus has been undiminished in support of sustainability initiatives for both ourselves within the group and also our customers, and that has involved quite a bit of substitutional investment in greener products for our rental fleet. Net debt that Alison will talk to in more detail. We're pleased that 62% at the 30th September was at a long-term fixed rate. And finally, in terms of highlights, we're pleased to report a 5% increase in our dividend, interim dividend, to 11 pence per share. So they're the highlights. We will talk to most of those points in more detail as we go through the presentation, and I'll now hand over to Alison to take you through the financials.
Thank you, Neil. So good morning, everybody. So Neil has covered a lot of the highlights. What I'd really like to emphasise or reprise on is the fact that we're pleased that we've had a solid first half with revenue up 6%, profit before tax and amortisation up 6%, and we've maintained our net margins at 11.5%. So we were pleased with the first half. Moving on to our return on average capital employed. This is a key measure for us, and we're pleased to report that in the first half of the year, this was maintained at 14.4%. We target 15% through the cycle, through the economic cycles that we have. And so therefore, when we are at 14.4%, we're comfortable with this level. I've moved the WACC up in my calculations. Last time I presented this slide, we were at 8. It's now moved up to nearer 9, which reflects the impact of higher interest rates that we're experiencing at the moment. That said, we wouldn't change the target of 15% through the cycle, and that's because this target was set some 20 years ago when actually the weighted average cost of capital was nearer 11%. So we'll stick to this target as a baseline. Moving on to dividends. As Neil's already mentioned, we're paying an 11 pence per share dividend for the first half, which is a 5% increase. When we come to the full year, we'll meet the policy that we restated or re-emphasised last year end, which was that we would have pay out 2 times dividend cover. And this policy reflects the fact that we like to reflect the increases in profitability, but also ensure that that profitability is sustainable in the longer term as well. My next slide is on the balance sheet. We have a strong balance sheet. And you can see that hire fleet has increased by 10 million in the first half of the year as we've invested. Neil will talk to our investment in fleet in a later slide. A key feature of the balance sheet this time, though, is that we've had a working capital swing. This swing, when we had the pandemic, we had a benefit from working capital inflow. This time we've had an outflow of working capital. And the two main areas of that is that it's an increase in debtors. There's a slide in the appendices that shows that 11 million of the swing was in respect of debtors and trade debtors particularly. Half of this was because we have increased trading, so we have a 6% increase in revenue. And the other is because we've, as you see at the bottom of this slide, debtors days have increased to 61, whereas at the financial year 2022, they were 55, and at half year last year, they were 58. We do tend to be around the 60-day mark, so I think we did have lower debtor days before, but we are very aware of perhaps there might be a tendency for some of our customers to pay us slower with the increasing interest rates and the cost of money going up. So we will keep on that, and we do have good credit control teams who are managing that for us. Moving on to our cash flow, a key feature of our business is we generate strong cash flows. We had a 7% uplift in EBITDA in the first half. We did book costs of 1.9 million of exceptional items. This was in respect of the formal sales process, which we announced in April and we ceased in August. These costs were part of they were financial and commercial due diligence in the main, which were in respect of doing a strategic review before we launched the formal sales process. I've already discussed the working capital, and the profit on sale, capital expenditure and proceeds will be covered by Neil in a later slide. But the upshot is that we did have an increase in net debt of 18 million. And there will be an interest rate impact because of the increase in SONIA, but I'm going to talk about that on my next slide. So as Neil's already mentioned, we are in a reasonably good position in the fact that 62% of our net debt at the end of September was fixed. We have two private placements with they're long dated ones maturing, as you'll see, in January 2027 and April 2028. So that puts us in a good position. That said, we do have a revolving credit facility, which is linked to SONIA, and SONIA is linked to the rate rises that the Bank of England have been implementing recently. So we are exposed for a part of our debt. And as I mentioned earlier, this will result in an increase in interest costs in the second half, although we haven't seen much of an impact in the first half. We had total facilities of 190.5 million, and since our net debt was 149 million at the end of September, we have almost 42 million of headroom facilities. And also within the revolving credit facility, we have a 20 million accordion, which is available for us to draw down from the banks should we require it for growth, for the right sorts of investments. And then my final slide is just to show the covenants that we have against our lending facilities. We have two covenants. EBITDA interest cover has to be above 3 times, and you can see that we're well ahead of that at 9.81 times. And then net debt to EBITDA has to be less than 2.5 times. And at the half year, it was 1.6 times. So again, we have good headroom against our covenants. And now I'm going to hand over to Neil, who's going to talk about markets and trading.
Thanks, Alison. So you've heard the financial backdrop from Alison. I will now try and give you some of the reasons why we've been able to produce the numbers that we have. The first element to cover is markets. Got 2 slides on markets. The first one is, if you like, the micro slide, which talks to how we at VP see key market segments. We serve on the left-hand side of the slide, you'll see the core markets that we as a group serve: infrastructure, construction, house build, energy, and then a range of other smaller markets which we service. The largest of those markets is infrastructure and construction, largest 2 of those, but they're all important. You'll see down the right-hand side of the graph that we've delivered growth in all bar one of those markets in the 6-month period. So I'll talk to those individually now. So in terms of infrastructure, which includes all the regulated markets that we support. It's been a good 6-month period for us on AMP7 work, which is the 5-year water industry investment programme, which was somewhat delayed and did not pick up last year as we had expected, but pleasingly we have seen pick up in activity in the first 6 months of our financial year. We have actually also seen some modest improvement in terms of rail industry demand, with the CP6 programme also starting to gain traction during the first half of our year. The only caveat to that is that industrial action over recent months has prevented some of the work that was pre-planned from actually happening. So our customers have not been able to complete the work that they were planning. Therefore, there has been a modest reduction in our expected activity levels, which we've gone, for the most part, we've managed to replace with other work. We've also been busy in other areas like Hinkley Point, and the one area that we were very busy on last year was HS2 on the phase 1 works. The expectation was that would continue this year in 2022 for phase 2, which is north of Birmingham. In truth, that majority of that work is still to be let, and therefore we've had a quieter period on that element of infrastructure on HS2, but with the government's recent pronouncement that they were still committed to HS2, we would hope that that will be something that we can enjoy the benefit of in 2023. Moving on to construction, which is 41% of our revenues. RMI, which was good last year, has been good in the first half, although it's not particularly growing. We've seen some useful activity from the repurposing of buildings, which has benefited some of our divisions. And we've also seen a little pickup in civil engineering activity, which has been beneficial for the likes of our ground force business. However, elsewhere, demand has been relatively flat, and I'll comment on that a bit further when I get on to the next slide. House building showed growth, and although there is some level of uncertainty looking into next year on house building from the market, we as a business enjoyed sustained demand throughout the 6 months, and we enjoyed sustained demand from a market where the supply of products to the house building sector was limited, and therefore we're hopeful that that will continue, even if there is a lapse in a minor lapse in house building activity going forward. In terms of energy, that looks a fairly drastic fall, but in truth, that's primarily due to a major shutdown contract that we completed at the beginning of last year, which does not repeat on an annual basis. In actual fact, our energy activity underlying is slightly better than it was a year ago. So there is some modest improvement coming through in that segment. And then my final comment on this slide is on other. Other includes some markets that perhaps were more affected by extended lockdown than others, and that would be outdoor events and the aviation sector, where some of our business units have become busier in those areas as there's been more activity. So that's the micro view. If we move on to the next slide, I've used the UK construction forecast from Experian. I did use this slide at the prelims, and so it's the same sentiment involved, but not surprisingly, perhaps the graphs to the right of the blue vertical line, which are the forecasts, have flattened somewhat. However, just to remind those who were listening last time and may not have heard before, the top left-hand quadrant, the top right-hand quadrant, and the bottom right-hand quadrant charts, which are all core market areas for VP, they did see some drop off, some more dramatic than others during COVID, but they all enjoyed a rapid recovery as we came out of the pandemic. And that was what has helped drive us back towards the pre-COVID levels that we were operating at as a group. Respectively, the infrastructure chart has flattened since April, since the April spring numbers that Experian put out. The new housing chart still shows some growth, but I think I'm sure if they were to do the plot today, it would be somewhat flatter again. And repair and maintenance is flat going forward as well. So for us, that if that's actually what happens, that's okay. We're operating at levels above or in line with pre-COVID, and we've got a relatively stable level of demand going forward. So which we like. We can plan around stability. It's when we get sharp shocks that it's more difficult. The elements of the group's markets which are not recovered from pre-COVID are illustrated by the bottom left-hand chart, where new non-residential, which includes things like new build schools, hospitals, commercial buildings, offices, that had already started to fall away post-Brexit. That accelerated during the pandemic, and as you can see from the chart, there's been very little recovery to date, and it's a very modest expectation over the next 2 to 3 years. So in terms of our overall business, we're very close to where we were pre-pandemic in terms of revenue, but the reason that we're not quite back to where we were is that bottom left-hand chart. Moving on, just quickly on group performance, I think the main point to say here is that we've delivered growth. We've delivered the 6% revenue and profit growth, but more importantly, perhaps we've also maintained margins as we've delivered the growth through a mix of pricing uplift and lift in activity, and despite the inflationary challenges that we've all had across our business units. The group split into two regional regions that we report, the first of which is largest is the UK. In the UK business, actually the growth was below our average for the group overall, but nevertheless tangible at 4% revenue, 3% operating profit, and again, little or no change in operating margin. The key comments on the UK performance would be, and backing up what I said on the market slide, is that AMP7 and transmission work has been supported throughout the period. We've seen a weakness in HS2, and we've seen a recovering rail market, but impacted by the recent industrial action. On construction, RMI and civils have been positive, but we've seen an ongoing lack of investment in and volume of investment in new build. House building has been stable, and margins have been maintained in what has been a lower market growth period for the UK economy. In terms of international, which is much smaller than the UK, pleasingly, we've seen good revenue growth half year on half year at 28% in the 6 months, and profits have more than doubled. So we've seen a good recovery in international markets. 2 reasons, really key reasons for that. In Australia and New Zealand, the lockdown it was extended longer than it was in UK and Europe. And so we've seen a bit more of a bounce back in this first half of our financial year. And on the other international business, our AirPack unit, we've seen the strength of oil and gas price attract a renewed focus on investment in that market. And so there has been some modest improvement in that market as well. Moving on to our fleet, rental fleet investment is very similar in this first 6 months as it was a year ago. So we spent 34 million on new equipment in H1 23, which is to September 22, versus the 32 last year. That investment has included significant substitution investment in green equipment solutions for our fleet, which in support of both our and our customers' sustainability aspirations. So a lot more battery powered, a lot more solar powered equipment coming into our rental fleet. We did accelerate investment. I did say this at the prelims. We were buying ahead of the curve to try to get into the queue for the extended supply chains, deliveries, and that is what we've done. I think latterly we've started to look a bit harder at whether we needed all of the product that we ordered up front, and I think this is becoming a market change where people are perhaps not going through with quite the level of orders that they originally made, and that together with the manufacturers starting to improve their supply of componentry, I think we're seeing a slight easing of the lead time issue on equipment and on spares. By no means over yet, but we are seeing some improvement there. My final comment on this slide is just that we have accelerated slightly in terms of disposals of equipment which is perhaps underutilised, where we want to turn that into cash. So it's quite a healthy hike in disposal proceeds during the period. So in actual fact, although, as Alison said on her slides, net book value of fleet has gone up, the net expenditure in cash terms on fleet actually was marginally down in the current period. So my last slide, or the last slide, is just on outlook. Undoubtedly, we're in a lower growth environment, and we as a team have to adjust our management of the business accordingly. So it's back to some fairly basic business management, efficient management of costs, mitigating supply chain inflation by agreed higher rate increases with customers, and setting a higher hurdle rate for further capital investment in light of what Alison was saying about interest cost changes in particular. So there's no rocket science there, it's basic good management principles, but we're very committed to that at the moment. In the UK, we expect there to be further strength in infrastructure. It's always volatile, but the spend will come through. And house building is difficult to call. We still think that even if there's a modest decline in house building, from a group point of view, we're still in a good shape to benefit from that market. So we're still, from a VP point of view, we're still relatively positive about that market sector. However, conversely, we don't see any particular sign of signal that's going to create a short-term revival in the construction sector, which we expect to be flat going forward. Further progress in international markets is expected. We are driving our own sustainability strategy as a group and supporting customer aspirations through where we're investing. We've continued to invest strongly in technology and also within our people in terms of learning and development. Trading for the year to date since the half-year results has continued in line with our expectations, which is pleasing. It's not an easy market out there, but trading is more or less where we expected it to be. So we've got a resilient and proven business model which operates in diversified end markets. So despite the headwinds of inflation, interest, slightly more challenged economy, we're confident of continuing to deliver outstanding long-term returns to our shareholders. So that's what Alison and I wanted to cover off this morning. I'll hand back to Hannah, who I think will deal with any Q&A.
Thank you, Neil and Alison. Right. This individual is interested to learn of the ultimate objective of ownership, given the recent exploration of alternative investment away from VP. Does this situation remain fluid, notwithstanding the strong backing they still provide?
No, I think we were very, obviously, and Alison mentioned the formal sale process. We ceased that process in August. The family trust, the independent trustees of the family trust, gave assurances to the board that there were no, at that time, there were no further plans for the foreseeable future to dispose of VP shares. And from our point of view as a board, that allows us to very clearly move on with business as usual, which is how we see things. You may have, I'm sure that anyone who saw the announcement will see that there was a parallel announcement where we had some board changes. Alison, my colleague of over 11 years, is finally retiring.
Yes, sir. Yep.
So we're bringing a new finance or CFO into the group at the beginning of January, and there'll be a handover period with Alison, and then Anna Bealby, who's joining us, will become CFO at that point. We're very pleased as Steve Rogers, who's another long-term member of the board, is also retiring. And we brought two new non-executive directors onto the board, Stuart Watson and Mark Bottomley, both of whom are strong additions to the group, our existing board members. I think, so why say that then? I think if anyone needed an endorsement that it was business as usual from the outside or internally, for VP, then I think that's it. Attracting good, strong directors into the group is a serious, shows serious intent on our behalf.
That probably half answers the additional supplementary question.
Okay.
On that subject around, have there been any ongoing distractions during that period, which, are you seeing any legacy effects from now that you've exited the FSP?
Yeah, I will do. So I think throughout the process, we've tried to avoid the distractions. So it was Neil and myself that did the most of the liaising with the advisors and that sort of thing. We did go along the formal sales process being publicly announced, and so there was the chance of it being a distraction, but we were quite clear to make it clear to everyone that they should carry on as business as usual. I think Jeremy pointed it out when we had an analyst presentation that we feel that was largely successful, and we put that down to the fact that Neil's been in place for a while. I've been here for 11 years, and I think we've got some good lines of communication and a level of trust built up with the business as well. So I think that our colleagues, they're very experienced as well, and they did carry on with their business as usual through the process. So there weren't any distractions in that regard. Once the process was announced as being finished, Neil called together a meeting of the senior team from around the country and the world, and we went through some of the issues that they might have raised and some questions. And I think that gave a chance to clear the air and sort of put forward the points that Neil's already made, that we're business as usual going forward as well as. So I think to the extent that there were distractions, it was Neil and I think we did okay with that.
Yeah, no, it did. I think I suppose the best signal on whether it distracted us is the quality of the results that we've just announced. That if it had been a major distraction to the business, then we wouldn't have been able to. And that the FSP was through the first 5 months of the numbers that we've just that we've just reported. So I think that's also a strong signal that we didn't get the businesses are not. We've got very strong management teams in all the businesses. They get on a day-to-day basis with delivering on their business aspirations, and I think that these results demonstrate that.
Thank you. Back to you probably, Alison. What will be the impact on your debt interest payment and your markets if the Bank of England base rates go up to 5% and stay at that level for the next few years?
Well, we mentioned that half of our facilities are fixed, and obviously Neil's mentioned some of the messages that we're doing about managing the investments and the hurdle rates. What we have forecast and what has been put into Paul's note and it was that the impact in the second half will be 1 million more interest, and we've put in the growth rates that the Bank of England have flagged going forward. So I think that's the best answer. I think we've got it covered in our forecast.
Thank you. On to current trading in the fleet hire element of the business. Obviously, you mentioned there about the interest from customers in green, electric options. Is the cost of this more expensive in terms of buying in? Is there risk that it could push down the return on capital metric?
Yeah, no, good question. There are a lot of products that we've been able to identify and bring onto the fleet where the capital cost of the substitutional product is not very different to the historic product that we would have used. So there are a lot of products where there isn't a significant change in the rental rate to the customer to have a greener solution, which is good. There are some products where there is a bit of a hike in the rate, but the fact that it's not burning petrol or diesel anymore means that there is a fuel consumption saving through the substitutional product. So then you've got to look at the total cost of operation from a customer point of view for certain products. But as working hand in hand with manufacturers and getting support from customers, we will continue to push the envelope. But the truth of the matter is that the larger the product at the moment, the more difficult it is to get a reliable solution. And the bigger the green premium is that you've got to pay to swap it out with a traditional petrol or diesel engine alternative. So I think it's a long way to go. We've made terrific progress. I think we, as we say, about over 60% of our fleet is zero emission at point of use anyway. So we've got about a third of our fleet that's the concentration of our activities in that substitutional area. For small to medium-sized products, there's some really good solutions out there which probably do work for customers. But then once you get beyond that, the cost of the equipment can be significantly higher, and that creates an additional cost that, despite the best intentions to reduce emissions, it just doesn't work at this stage. That will change. It will change over time. So yeah, I don't see it as an inhibitor to the performance of the group, that's for sure.
Good, thank you. Next question is around the lack of recovery in the non-residential market. Obviously, that's to some degree out of your control, but are you holding on to market share there, and what can you do to drive additional growth in that area?
Yeah, I think we could be confident to say we're holding market share in that segment just as we are elsewhere. I think that the way that we don't sit and wait for the market to recover, the businesses and Brandon Hire Station would be typical one. The businesses that are more exposed to that area are finding finding new routes to market with new products, new offerings, slicker ways of dealing with the customers in terms of technology and innovation, we're doing what we always do. We move to where the action is, and the reason that I showed the slide was to demonstrate that there is a latent opportunity there, but at the moment we can't see that being available for some time. It will change at some point, but we're not. I wouldn't want people to think that we just sat there waiting for that market to cover. I think that's more a case of being ready for that market when it happens. But in the meantime, as our numbers demonstrate, we're obviously finding alternative areas for growth.
One more on the sale process. The timing seemed unusual, bearing in mind market uncertainty during the start of the year. Could you talk about the timing of it? And supplementary to that, did the strategic review reveal anything that you can share with shareholders?
Okay. So to remind everybody that the decision or the catalyst to the decision to go with the FSP was a communication from a majority shareholder, to which the board had to respond, and taking into account that request, taking into account even the markets at the stage at which the process was launched in April, the board, along with advisors, felt it was appropriate to launch that process. What subsequently happened was that markets got worse, inflation got a lot worse, interest rises, there were a lot of political issues going on, and therefore I think by the time we ceased the process in August, the market had changed, not out of all recognition, but it was significantly worse, and perhaps we were just a bit unlucky in that respect, that the severity of the change from April through to August. In terms of the strategic review, I think we were pleased that there were no what we would call red flags through that process, but there was some useful information and useful observations that came out, which we've shared with businesses, we've taken into account ourselves. So there will be some value in that process for us going forward. But I don't think there was anything in the strategic review that made us think that we had to have a significant change of direction for the business.
Well, thank you to you both. That seems to be it on the questions for now. So we look forward to an update in another 6 months' time.
Great. Thank you very much, everybody.
Thank you, everyone.